Usually when we sit down to look at an industrial conglomerate, the vibe is, um, let's be honest, it's usually pretty sedate.
Steady. Predictable.
Exactly. You expect steady, boring growth, maybe a percentage point here or there. But I've been staring at this earnings release from Siemens Energy.
The Q1 2026 one.
Yeah, the report that just dropped on February 11th, and boring
Yeah.
is the last word that comes to mind. This feels different.
It really is a document that defies the usual expectations. I mean, I've read hundreds of these, and usually you're just looking for a tiny beat on earnings per share.
Right.
But this reads less like a corporate report card and more like I don't know, a status report on the world's entire infrastructure.
Yes. We're looking at a company that builds massive gas turbines and grid transformers. Heavy, physical machinery. Yet the financial profile looks more like a tech scaler in some places.
Well, the headline number says it all.
The backlog. They're sitting on an order backlog of 136 billion euros.
That number is the anchor for this entire conversation. 146 billion. To put that in context for you listening, that is larger than the entire annual GDP of a country like Morocco or Slovakia.
So it's not just a healthy pipeline.
No, it's a mountain of work that effectively guarantees their existence for years to come.
And that's our mission for this deep dive. We aren't just reading a balance sheet to see if Siemens had a good quarter. We're trying to figure out what that 146 billion tells us about the world we live in right now.
Because when a company sells that much power equipment, it suggests the world is absolutely terrified of running out of electricity.
Terrified might be a strong word, but it feels accurate.
It is. If you read between the lines, this report is basically a global anxiety index for energy security. Governments, tech companies, they're all scrambling to make sure the lights and the servers stay on.
So let's start with those headline numbers. Christian Bruch, the CEO, he called this a very strong start to the fiscal year.
He did.
And usually, CEO optimism is something I take with a huge grain of salt. It's their job. But looking at the net income, he might actually be underselling it.
He's being surprisingly modest. I mean, if you look at Q1 of last year, 2025, they made 252 million euros in net income. Respectable, fine.
It was fine.
But this quarter, 746 million, that is nearly a tripling of net income in just 12 months.
Okay, but here's where I need you to connect the dots for me, because the math doesn't seem linear. Revenue, the actual cash they collected for selling things, was only up about 13%.
Right.
So how do you get a roughly 200% jump in profit from a 13% jump in sales?
That is the most critical insight in this entire report. It's a textbook example of what finance people call operating leverage combined with serious pricing power.
Okay, let's unpack operating leverage. It sounds like jargon, but it feels crucial here.
It is. So think of it this way. Siemens Energy has these massive fixed costs. It costs a fortune just to keep the factories open, the lights on, and the thousands of specialized engineers employed.
That's the baseline you have to cover every month.
Exactly. Last year, they were selling enough to cover that cost and make a little bit of profit. But once you cover those fixed costs, every additional dollar of revenue flows almost straight to the bottom line.
Because their costs don't go up at the same rate.
Right. You don't need to build a new factory to sell one more turbine. You just run the existing one harder.
So the first billion covers the bills, and the next billion is pure gravy.
Oversimplified, but yes. And on top of that, look at the phrase they used in their report. Improved margin quality.
Margin quality. That sounds like polite corporate speak for we raised our prices.
It is, but it's justifiable. Look, 2 years ago, they might have taken any contract just to keep the factory busy. They might have offered discounts just to win the bid. Now, because demand is so high, they can be picky. They aren't just selling more. They're selling it at a premium with better terms. They don't have to discount to win business anymore.
That lines up with the book-to-bill ratio. I saw that sitting at 1.82. I know that's good, but explain why it's that good.
A book-to-bill of 1.82 is incredibly aggressive for an industrial giant. So, for you listening who doesn't spend your day in Excel sheets, a 1.0 means you're replacing what you sold.
You're stable, but you're not growing.
Exactly, you're treading water. A 1.82 means for every euro of equipment they shipped out the door, customers placed orders for nearly 2 euros of new equipment.
They're piling up work almost twice as fast as they can finish it.
Which implies the company has to grow just to catch up.
Which brings us back to that 146 billion euro mountain. But let's look at what they're selling. Because the narrative for the last decade in the media has been green energy, wind, solar.
Right, renewables.
But looking at the engines of growth in this report, the hero isn't wind, it's gas.
It's the great irony of the energy transition, isn't it? Gas services had its highest order intake ever, 8.75 billion euros in a single quarter.
Ever.
Ever. And we're not just talking about service contracts to fix old plants. The report explicitly mentions strong demand for new units.
That stood out to me too. We're supposed to be phasing these things out theoretically, but we're building record numbers of them. And look at the geography: the US, Poland, Turkey, Taiwan.
It's a geopolitical map of energy anxiety. Take Poland. They're trying to get off coal to meet European carbon targets. What's the bridge?
Gas.
Gas is the only viable bridge that provides enough power right now. Turkey needs energy independence. But look at Taiwan. Why does Taiwan need massive, reliable, new gas turbines?
Semiconductors.
Exactly. You cannot run a fabrication plant for advanced chips on intermittent power. If the wind stops blowing for 10 minutes, your lights might dim. Annoying.
Sure.
If the power fluctuates for 10 milliseconds in a TSMC plant, you ruin millions of dollars of silicon wafers. They need dispatchable power they can control instantly.
So paradoxically, to support the highest tech industries, we're doubling down on traditional gas turbines because they're the only thing reliable enough.
Precisely. And that reliability factor leads us to the U.S., which is popping up everywhere in this report.
It's the biggest driver for gas and for grid technologies, too.
The U.S. is the perfect storm right now. You have an aging grid built in the 60s and 70s. It's crumbling. Then you have the electrification of everything, EVs, heat pumps.
And on top of
that crumbling infrastructure, you drop the biggest energy consumers since the invention of air conditioning, AI data centers.
The report actually calls that out specifically in the Outlook section: strong growth of data centers. It's rare to see a utility-focused report be so explicit about a tech trend like that.
They have to be. It's moving the needle that much. You have to understand, a data center isn't just a building with computers, it's a massive industrial load. Some of these planned AI campuses need as much power as a major city.
That's mind-boggling. So when we see grid technologies revenue up almost 27%, that's basically the tech industry writing checks to upgrade the plumbing so they can run their models.
Precisely. You can have all the NVIDIA chips you want, all the smartest algorithms, but if you can't plug them in, they are just expensive silicon doorstops. Siemens Energy is selling the pickaxes for the AI gold rush.
Speaking of things that haven't been a gold rush, let's talk about the wind sector. Siemens Gamesa.
Ah, yes. The turnaround story.
Turnaround is a polite way to put it. For years, this has been the anchor dragging the whole ship down. Quality issues, massive losses.
It's been a problem child.
But looking at Q1 2026,
Yeah.
Christian Brunch says there are early signs of modest improvement. Is he just spinning this, or do the numbers actually back him up?
The numbers do back him up, but you have to look past the headline order volume. If you just look at orders, they collapsed, down 33.7%.
Which looks terrible. If I saw a 33% drop in sales, I'd panic.
It looks terrible, but it's statistical noise. The wind industry is incredibly lumpy. Last year in Q1, they booked one single gigantic offshore wind project in the North Sea worth 1.4 billion euros.
So that one deal just skews the entire comparison.
Completely. You can't land a whale like that every quarter.
Okay, so ignore the top line drop. What about the bottom line? Are they still losing money on every turbine they sell?
They are, but the bleed has slowed dramatically. In Q1 2025, the wind division lost 374 million euros, just burned it.
Wow.
This quarter. The loss was 46 million.
That is a huge swing. They're almost at break even.
It is. They shaved off over 300 million in losses. That tells me the technical fixes are working. They're not spending as much fixing broken blades, and they're getting better at pricing their contracts.
There was an interesting detail in there about a repowering order in the U.S. What exactly is that?
It's a really smart way to generate revenue without the headache of building a whole new wind farm. You go to an existing site with, say, 15-year-old turbines. You take the old blades and engine off the top. You leave the tower and the grid connection. Then you put new, high-tech, larger blades on the existing infrastructure.
So you get more power from the same footprint.
30–40% more power using the same land and the same grid connection. It's the path of least resistance.
There was one ugly number in the wind section, though, the special items. Costs related to selling off the Indian wind business.
152 million euro hit. It's messy, yes. No one likes that. But I actually view that as a positive sign for the long term.
How so? Losing money is positive.
It shows discipline. The management team is saying, it doesn't work. We can't make money there. Cut it. They're taking the hit today to clear the books and move on. It's ruthless, but it's necessary if they want to hit that break-even target this year.
And they seemed confident they will hit it. The guidance confirms it. If they pull that off, if wind stops losing money, what does that do to the overall company profitability?
It uncorks it. Right now, the gas and grid divisions are effectively subsidizing the wind division. If wind just hits zero, the group's profits will look absolutely massive.
Let's talk about that subsidizing power. We need to talk about cash flow. Because profit is an accounting opinion, but cash is a fact. And the free cash flow number here is wild. 2.9 billion euros?
Up from 1.5 billion last year, it almost doubled.
And the report lists a reason I found fascinating: customer advance payments.
This is my favorite detail in the whole report because it tells you everything about the power dynamic in the market right now.
Usually a company builds a product, delivers it, sends an invoice, and then waits 60 or 90 days to get paid.
Right, that's a buyer's market. But right now, utilities and data center operators are so desperate to get their transformers in 2027 or 2028 that they are paying Siemens up front just to reserve a manufacturing slot.
So the customers are essentially acting as the bank for Siemens Energy.
Exactly. It's what we call negative working capital. They're getting the cash before they spend the money to build the thing.
It's like the luxury car market. You want the new Porsche? Put down a deposit and wait 2 years.
It is exactly that. But instead of a sports car, it's a high-voltage grid stabilizer that keeps a city from blacking out. The stakes are a little higher.
Just briefly, I don't want to skip the third division entirely.
Right.
Transformation of industry. It feels like the quiet middle child.
It's the steady, reliable earner. Orders up 11%, revenue basically flat.
0.5% growth, the definition of flat.
But look at what they do. Industrial compression, electrification. This is the stuff that helps oil and gas companies lower their own emissions. It's not flashy, but it's sticky. It's a cash cow, the ballast in the ship.
Okay, so let's look ahead. The outlook for 2026? They confirm their guidance.
Which, in this volatile world, is good news. No news is good news.
But the targets are big. Revenue growth of 11 to 13%, net income between 3 and 4 billion euros.
If they hit the upper end of that 4 billion in profit, that puts them in the top tier of global industrial companies. And remember the macro drivers they listed?
Right. Rising energy demand, electrification, digitalization.
It feels like a Venn diagram where Siemens Energy is sitting perfectly in the center.
How do you mean?
Think about it. You have the old economy, heating homes, running factories, that needs gas services. You have the transition economy, building renewables, that's wind. And you have the digital economy, AI, and data centers.
Which needs the grid.
Right. There isn't a single major global trend involving hardware that doesn't pass through their order book.
That brings up a question I've been mulling over. We talk about how companies are paying in advance, how data centers are sucking up capacity.
Right.
Are we moving toward a world where access to reliable power becomes a luxury good? If Google and Microsoft can pay massive reservation fees for grid equipment, does the local municipal utility get pushed to the back of the line?
That is the multi-billion-dollar question, isn't it? We are seeing a scarcity of infrastructure. The factories that build transformers are full. The specialized ships that install wind turbines are booked. If capacity is finite, it goes to the highest bidder.
So we could end up with a two-tiered grid, a premium grid for the AI giants who need 99.999% uptime and can pay for it.
And a legacy grid for the rest of us that's struggling to catch up. It's a very real risk.
Wow.
You look at that 146 billion euro backlog, that's not just a measure of success. It's a measure of congestion. It's a waiting list. And when the waiting list is that long, the people with the deepest pockets usually find a way to skip the line.
That is a sobering thought. We think of electricity as a basic right. You flip a switch, the light comes on. But the machinery behind that switch is becoming the most contested resource on the planet.
And Siemens Energy is one of the companies controlling the turnstile. They're deciding who gets the equipment and when. That makes this earnings report more than just financial news. It's a signal about who holds the power literally in the next decade.
Well, on that note, I think we've successfully unpacked the $146 billion question, a record-breaking quarter, a tentative turnaround for wind, and a massive bet on the world's hunger for power.
A very strong start to the year, indeed, and a fascinating time to be watching this space.
Thanks for walking us through it. And to everyone listening, the next time you see a transmission tower or a wind turbine on the horizon, remember, there's a massive, high-stakes economic war happening just to get that piece of metal standing there. We'll catch you on the next Deep Dive.